Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
There's a lot of uncertainty going on in this world right now, which is driving a lot of questions. Last week, Cameron and I did a live Q&A to answer these questions. There were such good questions, and we hope that you agree that there's some good answers. We decided to turn this into our podcast this week. Hope you enjoy it.
All right. Well, welcome. We appreciate everybody joining us today. Today we're doing it a little bit different. What we wanted to do is we just wanted to be available to you guys, and we're going to host probably an hour here of just kind of a general question and answer. And we've been getting questions all week, and so we wanted to, like I said, be available for you guys. We're going to answer probably, maybe 5 of the top questions that we've gotten this week. And then if you guys have anything, feel free to add it into the chat or text Anthony or I, and we'll get it in there. And as you can tell, as we are practicing social distancing, it's us driving into the office today, and I feel like I've got a little head cold. And so Anthony's in the studio, and I'm recording from our office. And so we're going to get through this thing. So Anthony, is there anything you want to start while we get started? Anything you want to add?
No, let's dive into it. Again, if you're not sure how to use the chat box or the question box, one thing you can do is you can actually text our business line, which is 702-850-8100. You can text in the question. Our plan is that we're going to do this for an hour, but we're going to be here as long as you need us. We're going to make sure that we answer your questions. Let's see. Phil raised his hand.
So everybody that's on you guys should have gotten an email this week that just kind of stated kind of how we are implementing some of the restrictions that have happened here in Las Vegas, Nevada. We are certainly still open for business. Customer service is paramount to us, and so we want to be available to you guys. But all of our meetings for the last week or so have all been done virtually and or conference calls. And so that's how we are going to continue with business for the foreseeable future. So if you guys have any meetings or anything that you guys would like to discuss with us, we're certainly available. Just reach out and let us know. We'll get something scheduled.
Perfect. And to clarify, the insurance companies are working as well. They have remote working procedures, and they will be working and servicing. So we are all here to help. One thing I will say, what we're going to talk about here, well, in regards to the virus, Cody actually shared with me a white paper. It's about 20 pages that was put on by, I believe, 10 doctors from Great Britain and the United States. That has some great scenarios and studies to explain what's going on and how we can handle this. We're going to put that link to that white paper in the chat box, but we're really not going to focus so much on the virus. We're going to focus on really things that we can control. And so we are here to answer your questions. So let's dive in. Cam, what's the first question?
Number one question that we've had, and I've had a bunch of phone calls, a bunch of text messages is, hey man, what can I do to adjust my premiums? Right? I think everybody's kind of going through it. I think most of Las Vegas is on a 30-day lockdown. That means not going to work, not having any income. Anthony, what would you suggest what's your first option when somebody calls you and says, hey, what can I do to adjust my premiums?
What I would tell, again, the first thing I'm saying is let's not panic. Let's see how this whole thing plays out. So a couple options we have, some easy ones, is if you have some automatic loan repayments, we can easily stop those. Also, with our premiums, if you can remember, there's actually 2 types of premiums. The first one is the paid up additions, which I call the want to. Those are optional. The other premium is the base premium, or what we like to call the have to. That's what has to be paid. So let's just say a simple example, your premiums were $1,000 a month. Typically, your PUA is going to be about 60% of that. So very easily, the first thing would be to stop the PUAs, continue to pay the have to premium. But let's say that you can't make that premium. What we can do is we can use your cash value to take a loan to pay the have to, right? And a couple things about that. On the bright side is that if things in your personal economy, like we really don't know where it's going to be in the next 6 months or 2 years. So we want to have some flexibility. We want to have some options. By taking a loan, that will make sure that your policy stays in force. But also with loans, if you're unable to pay that back, we can write off that loan. Okay, then, but the downside of that is once it's written off, you cannot pay it back. So that's one thing that we do want to consider when we're writing off loans. Also, okay, perfect. And if you have any issues with concerns about making the premium, let us know. We can walk you through the options, and we can help you with the paperwork. A couple things about that I do want to share is that is if you do that. In fact, I had a client who we met the other day, and she's not laid off yet, but she's kind of anticipating. So what I'm telling people that if we do stop loan repayments or stop our premium payments, what I would encourage you to do is let's still practice the skill or the act of saving. So again, in that example, at $1,000 a month, if we stop it in your policy, what I encourage you to do is, if you can, if cash flow allows, let's just take that $1,000 and put it into a savings account. Okay, so that way, when things settle down, let's see how much you have in the savings account, and then we can take that and put it back into your policy. Because again, one of the advantages of using a loan to pay your premium is that we're not breaking the compound interest curve. So in times like this where you can't make the premiums, that's going to be okay. We use a loan, we pay it back, whether it's 3 months or 3 years. When we do that, your cash value is still up there, continuing to compound. Another thing, some of these questions are probably going to get a little intertwined, but I think one of the questions we have is our banks, how safe are banks? So another thing I would talk about, maybe you can't pay the premiums with cash flow, but if you have some cash outside of your policy, maybe in a reserve, or maybe you've taken some money out of the stock market, you need a safe place to put it. That's one of the many reasons why we have these policies, is a safe place to store cash. Anything you want to add on that, Cam?
No, it's kind of just to jump back to that first question. What you talked about is what can I do to adjust my premiums? Just to lay it out for everybody, is kind of our first option would be to stop any loan payments, right? Is a lot of times we've taken a loan against our cash value and we've got money that we're paying back. Is we can always call up the insurance company and just say, hey, put that one on hold, right? We kind of control that structure of the loan repayment. So we can do that anytime that we want to. And then just to reinforce what Anthony says is we can stop or drop that PUA payment. And then for that base premium is we certainly can stop that too. But another option to consider is using the cash value to pay for that for the next couple of months moving forward. So just kind of reiterate that. And then you kind of transition right into our second question, which is how safe is the banking system? And how safe is my cash value? Is Anthony, if you want to maybe take a second and maybe highlight the difference between having cash on hand and in a bank versus having cash available in an insurance company or with an insurance company in your insurance policy. What would be some of the differences there?
First thing I want to explain is really your cash value. Just as a reminder, your policies are not tied to the stock market. When that stock market just went down about 30%, your cash value crept up a little bit. This is why we use whole life. It's not exciting. It's actually boring, but in times of this, I think boring is the new exciting, right? Your cash value is still there. Remember, insurance companies were built for times like these. The companies that we use are all mutual companies. That is, I think, very big right now, because again, a mutual company is owned mutually by its policyholders. They're not on the stock exchange, meaning they're not having to report their quarterly earnings and trying to create value for the stockholders. They're worried about you and me. They are worried about policyholders. All the companies we've used, not only are they mutual, they're 100 years or older. They've paid dividends every one of those 100 years, which means they paid dividends during the Great Recession and during the Great Depression. I went ahead and took a look at the top 3 companies that we use on their last annual report, which actually is the end of 2019. The average cash on hand they had was $270 million. So that's $270 million in cash. We're not saying that that's in some sort of investment. That is just sitting in cash. And looking at their liquid assets, meaning that they could sell within a day, the average is almost $10 billion. Companies are very liquid, they're very secure, and they're very boring. And that's exactly what we are looking with right now. Two of the companies, I was able to get the amount that they have in surplus. That surplus means that money that they had set aside in reserves for an unforeseen situation, like what we're in right now. The average of those companies is 1.5 billion. Okay, they have $1.5 billion in assets sitting in reserves waiting for times like this. Okay, so the question goes to be is, well, how safe is my money in a bank? Here's a little trivia question. How many banks have failed since 2008? If you have a guess, please put it in the chat box. I'm kind of curious. And then say, how many mutual life insurance companies failed during that same time?
From 2008 to now?
Yeah.
I'm gonna venture a guess. I'm gonna join you here.
Okay. Valerie put 0, and I'm assuming that she's referring to mutual life insurance companies. Somebody said 650 banks failed.
That was my guess.
I went ahead and pulled this up from the FDIC, and okay, Brian says 1,000. The actual number, according to the FDIC, is 546. 546 banks have failed. 0 mutual insurance companies. Okay, so Valerie, you are right. This is an example in regards to the safety of your money. Nobody has a crystal ball on what's going to happen in the future, but what we can do is look in the past and see who was in the best situation when there was difficult times, and that is mutual life insurance companies. Right now on the FDIC watch list, there's 54 banks that before this happened were already in trouble. I can only speculate that number is going to skyrocket. And some of the differences here, banks and insurance companies work some ways the same, but in some key ways different. With banks, the amount that they need to have in reserves is very small. And if you may have heard about fractional reserve banking, where you put, say, $100 in, the banks can turn around and loan out $900. So for every dollar you put in, they're able to loan out $9. When things are good, that's awesome, right? Because they're only paying interest on that $1, but they're receiving interest on $9. When things are bad, it makes it even worse for banks. Insurance companies are not able to practice that. They have very high reserves, and in the United States, no life insurance, no valid death claim has not been paid. So as far as saving money, putting money, it's the best place, we believe, is inside your policy. In regards to banks, one of the key issues, if you remember, you know what I think is interesting, everybody is talking about FDIC and want to make sure that their funds are insured. If you remember, before 2008, it was only insured up to $100,000. So anything over that was not FDIC insured. When all those banks crashed, the FDIC bailed out the banks until they couldn't. The FDIC, as far as an insurance company goes, is not fully funded for the amount of risk that they have, and the FDIC needed a bailout. So they got bailed out by the U.S. government, aka the taxpayers. When they did that, you may have heard of the Frank Dodd Act. And in there, they said, hey, we're no longer going to bail you guys out. Well, instead, we're going to have what's called a bail-in. We're going to put a link to an article that explains that. But in essence, is if the FDIC or if a bank fails and there's not enough reserves inside the FDIC, then all those depositors who are owed money are going to become unsecured creditors of the bank. Let me rephrase that. Unsecured creditors. If you know anything about bankruptcy, unsecured creditors are one of the last ones to get paid. Okay, so if you look at what the FDIC has in reserves compared to the total risk, what percentage do you think it is? I'm curious. If you could put something in the chat box, would be great. But so meaning, if for every dollar that the FDIC is insuring, how much do they have on hand? As you're typing this, let me just tell you the number is about 1.5%. So this FDIC Insurance Corporation only has 1.5% to be able to pay their total amount of risk. So I would be very concerned about having too much money inside a bank, which is what we would encourage people to do is, and this is what I've personally done before, is I have 1 month of expenses in my savings account at Chase, and then I have 1 month of overhead in my business. Anything over than that, I'm putting it into my life insurance policy. I'm doing that because it's safe and it is liquid. So what I would be looking for is if you have some other cash inside a bank and you have some policy loans, great place to put it. Because if we look at it, you put it into that policy loan, in essence, you're saving 5% of that. That's typically what the loan rate is. If you're saving 5%, that in my eyes is the same thing as earning 5%, right? So where else could you earn 5% guaranteed without and all of that being tax free?
So Anthony, let me jump in there. What you just touched on was a question that we've gotten several times over this week, which is how much should I have in each? And each meaning kind of my savings accounts, checking, and or my policy. And what you had just discussed is having kind of 1 month expenses in your checking account and then 1 month of business overhead kind of in your business accounts. Is that correct?
Yeah.
Cool. Perfect. Anthony.
What I will say on that is if you don't have the policy loans are a great, very easy place to put the money because it's also because it's very liquid. If you don't have room inside your policy and you are concerned about the safety of the banks, I've had many calls on that. Let's schedule a meeting and we can talk about some places to store the money. And we have a few solutions where it's liquid. It's going to be asset protected, and it's going to be safer, we believe, inside compared to a bank.
And kind of the difference between having it in a checking or a savings account and then having it inside of our policy. Maybe we can touch on the accessibility differences between each of them, right? Is having it in a checking account is much more accessible and not much more, but right now, I guess what I want to touch on is the differences maybe in the time between accessing policy values. Anthony, maybe can you touch on that?
Now, typically we tell people that you can access the money inside your policy in a week. Typically, if you've taken some loans, oftentimes it is going to be faster than that. With everything going on, I'm giving everybody a heads up. Everything is moving slower. I would anticipate that it's probably going to take 2 weeks to get a policy loan. It very well may be sooner, but right now, let's set the expectations that things are going to be slower.
Awesome. Let's move along to kind of this is lines of credit. Austin asked us here, and I know that you made a post this week, Anthony, on this, but Austin asked us thoughts of using a HELOC to fund a policy, and then maybe you can touch on that, and then also maybe we can address maybe tapping into a line of credit right now, just given kind of the economic climate. What do you think? Okay,
great questions. What I'm telling people, or we are telling people, if you've been listening to our content or listened to us for years, we've been saying a recession's coming. A recession's coming. But each time the government is propping it up and delaying it, and we believe the longer they delay it, the harder it is going to be. Particularly if you read Robert Kiyosaki's newest book, Fake. He goes into very good detail about that. And if one of an American economist, Robert Murphy, I heard him speak in February, and he said that there's going to be a recession in July. He said that in February before all of this thing that is going on, right? Which is why we had him on our podcast. And then the following episode, we had 10 things that you can do before the recession happens. So I would highly encourage you guys to go listen to that podcast. We also have a blog post that summarizes that as well. As far as lines of credit go, you've heard us say time and time again, banks will only loan you money when you can prove you don't need it. I've had a equity line of credit on my house, and I have a business line of credit. Both of those lines over the last 10 years have been frozen. Remember the golden rule that Nelson talks about? He who has the gold makes the rules. If the banks want to freeze or stop your line of credit, they do not even need to tell you. All they need to do is click a button in their system. What I'm encouraging people to do, if they are concerned, and I actually did this over the weekend, so things are getting a little more stressful. I don't know what's going to happen in the next 3 months. What I do think is important to have liquidity. We need to have cash on access to capital now in case we need to pay our mortgage or there's a hiccup in our business. Also, there's going to be opportunities. I want to be in a position to be able to take advantage of both of those. So what I did is I went to my bank and I pulled my line of credit. I didn't pull all of it because when you max out, just like a credit card, if you max it out, they get a little concerned. So I took out about 90% of it. And you know what? I did not care what the interest rate was. You're going to hear us often talk about, let's not worry about rates. We need to focus about volume, about dollars. How much is that going to cost me? Not in the rate, but in actual dollars. What I calculated, that's going to cost me then interest if it's 8%, $300 a month. So I was expecting to have this for about 3 months. So let's just round that to $1,000. To me, that's like an insurance policy. Right now, I don't need the money, but if I do need it, the bank is not going to want to lend it to me. I'm taking it right there. And to me, that $1,000 is buying me some reassurance. Then the question is, well, what do I do with it? So I deposited. These were at two separate banks, and then I went over to Chase Bank and I deposited it, and then now I have this money in Chase Bank, and I don't want it sitting there. So what I did is I took it and I applied it to one against one of my loans. Now it's there. It's out of the banking system. It's liquid. I can get it in 2 weeks, and I've secured that I'm being able to access those funds. Now we start looking at the math. Since that is inside my policy, I'm actually saving 5%. Now you might be thinking, well, that's still, I'm paying 8, but I'm saving 5. I'm still losing 3. Well, looking at that, what that means, instead of this costing me $1,000, it's only costing me about $300. But then we look a little bit deeper. My business, this is a business line of credit that's in my business. Business interest is tax deductible. So to use simple math, say that 8, after I take the tax deduction, it's going to be about 5. So in my eyes, it is going to be a wash. But just as I said before, I don't care what that rate was. It could have been 10. It could have been 20. For me, I need to protect my family and my business. And I want to be there when it comes to opportunities.
How did I know that?
Go ahead.
I was just going to say, how did I know that you'd work taxes in there somewhere?
You know it, buddy.
I knew it was going to come up somehow. Great point. So just to remind everybody, we're not saying that we have all the answers. We're sharing our beliefs and what we're personally doing, and we encourage you to do your own research. Don't just take our word for it. Do some other research, and you determine what is going to be best for you and your family.
Spreadsheet. Now, and I think Austin, because I actually know Austin, and if you don't have room in your policy, right? I think what he was asking, the question was, should I take a HELOC to fund a policy? I would say we need to talk on that one-on-one, because we need. I'm not going to give you an answer right away, but what I will do is when we meet Austin, I will explain all the downsides that could happen in regards to the HELOC, and then also what. Then we're going to explain the advantages.
It's a great point. I think we plan on doing a podcast to address this. Is this idea, one idea that's kind of been floated around the last several years is this idea of velocity banking, where you're kind of using a HELOC or line of credit against your house as kind of your storehouse of wealth of, hey, you're choosing to kind of build up equity in your house and draw on it every single month and pay it back. And so we're going to address the pros and cons of that here pretty quickly in one of these podcasts, because we get that question that comes up. I wouldn't say often, but at least several times a month, somebody will call and ask us about that. So we'll address that more in depth here moving forward.
You know, one thing, I know I'm kind of circling back, but sorry guys, we just kind of put this together and we're just trying to do this to help. In regards to making your premium payments, I just want to remind people, if your policy is more than 2 years old, typically you put $1 in and you can take $1 out. So what that means is, if you are concerned, well, I'm not sure if I'm going to have a job next month, just know if you do decide to pay the premiums, you are increasing your liquidity. This isn't like a 401k where you put the money in and then to get it out, you have to pay taxes and a penalty. Okay. Oh, you know what? I got a question here from JC from Arizona. He says, since Vegas is closed, or the state is closed for foreseeable 30 days, that means Cameron's going to miss 3 or 4 haircuts. What is his contingency plan? You want to take that, Cameron?
So we're close for.
Tell me now, don't lie. Tell me that worry has not crossed your mind.
So when I heard that we were getting closer to 30 days, the first thing that I did, Anthony pulled his line of credit. I went to the barber and I got a haircut. I snuck it in there, and my contingency plan is to have my wife Jessica cut my hair. She actually cut my hair for probably 10 years. And now with kids and everything else, she's busy. So I hope that appeases everyone. But Jessica would be my contingency plan. So Anthony, speaking of kind of contingency plans and having Las Vegas being on lockdown essentially for 30 days, what are some of our suggestions for people to do here in the foreseeable future? So if nobody can go to work, what are some thoughts on what they can be doing here in the next 30 days?
Well, we're telling, a lot of our listeners are working a lot, right? They work maybe 40 to 60 hours. And I'm sure they've thought, man, it would be nice to just relax and do nothing for 30 days. So what we want to try to do is control that. A lot of it's going to happen in the next 30 days is going to be about your mindset. We want to be positive. Know that we are going to get through this. And if you read that white paper, that provided some assurance to me. I don't know how difficult this next year is going to be, but us as Americans, we've gone through some difficult times, and we will get through that. What we're encourage our clients to do is that we want to do some things now. So in a year or two, we are in a better position than we were 2 weeks ago. One of the things we're encouraging clients to do, let's spend a ton of time as we can with our family. I know my daughter's home, and I like doing puzzles. It's kind of something that helps me de-stress. But now my daughter, I mean, she's looking for things to do, so she's helping me. It's been a great time for us to share and talk and listen to some music. And from the things I've read, one of the important things to do is, if you need to stay in your home, is that create a routine. This isn't adult summer vacation. Ideally, if you wake up maybe at a certain time, go to bed at a certain time, and try to have as normal life as you can. But during this time, this is a time to sharpen the saw.
Yeah.
Right? The sharpened saw means investing in yourself and spending some time on yourself. I'm sure there's some books you wanted to read for fiction, but there's probably some nonfiction books that you now have time to do. So a lot of it's going to depend on some of your goals, but a few resources that I would recommend. One is biggerpockets.com. If you're looking to invest in real estate, create that passive income, this is all that Bigger Pockets is. It has to do. They do webinars. There's articles that you can read. There is a free version where you can get access to it, and there's actually a paid version as well. But if you want to do some things when we settle down, then let's start learning about it now. What are things we have on our list, Cameron?
Yeah, great point. Right. So we got, let's spend some time with family. We got personal development, and none of that kind of personal development is like Anthony says, hey man, let's spend some time educating ourselves so that, man, we've always got that next thing that we want to do. And if it's real estate, we can look at Bigger Pockets. Another thing that we can do is we're going to be having a podcast come out on Tuesday that's going to highlight kind of the community. And the community is a group that some colleagues of ours started, and it's a community of people that are practicing IBC. And really what they do inside this community is talk about opportunities in which they have used their cash value to create income streams and cash flow. And so that would be a great opportunity. We'll put a link there in there. I would also recommend, man, you guys spend some time, go back and listen to some of our previous podcasts. We've had some really, really good guests on here, and I know some clients have missed some of them, but one of them that I would certainly highlight would be Mark Podolsky and the Land Geek. He talked about opportunities in flipping land, and that one, to me, man, he kind of blew up maybe 2 or 3 big kind of assumptions that I had in land that actually were pretty interesting, and opportunities to create cash flow there. The other one that I really like that I recommend a lot is Liz Nowling. We interviewed her. She's with Mid-South HomeBuyers, and they've got turnkey rental properties. And man, great interview. She kind of tells us how they find their properties, how the whole business got started, and just highlights some of the cash flow that you can create in a couple different markets through their company. And man, one of my favorite podcasts was we had Alexander Felice, Mr. Hype himself, came in and talked about the burst strategy. And man, he's all over Bigger Pockets. And so if you spend some time in there, you'll see some of his articles that he's written. And just a great opportunity to create some cash flow, you know, that not a lot of people are aware of. So those would be a couple of them.
Great, Cameron. I'm going to add a couple things to that. If you listen to the podcast that we did with the Land Geek, in there he gave our listeners I forget what he called it, but I think there's like a series of 9 videos that he sells for $97. But if you use our link, it is free. And one thing we haven't promoted much is really, we actually have a online course, the infinitewealthcourse.com. And what I'm going to do here, I'm going to share my screen.
Anthony, while you're talking and doing that, I'm going to share some of these things in the notes.
Okay. If you go to infinitewealthcourse.com, we got a couple options for you to get access to this content. Well, let me show you the content first. Once you create an account and log in, we have a ton of videos here. We, of course, have some on the infinite banking concept. This one here is absolutely my favorite series of videos. In this, we talk about how we can create passive income from our policy. And then we talk about, well, how do we know if that's good or not? So we compare it to investing in the stock market and compare how much income we're going to have in retirement. And then this one here, in addition to that, remember with the infinite banking concept and this policies, this is not an either or. We're not telling you to put your money in life insurance or real estate or your business or whatever that is, that this is an and asset. That you put your money inside the policy and you invest in real estate and your business. And on here, we actually do some examples of if you leveraging your policy to buy some rental properties. And then this one here, we actually talk about, well, do I really need life insurance or a policy to buy real estate? Why don't I just buy it straight in cash? Well, we often hear us say that we do the math. In here, we compare, should you buy in a property with cash and buy in a property through a policy loan? And I will say, this one is my second favorite. We often get asked, should I get a 15 or a 30-year mortgage? Common financial advice tells us it's a 15 because we're going to pay less interest. But what we do is we look at the whole picture. We do the math on a 15 and a 30. And really, if a 15's better, then wouldn't paying it in cash be better? We go through there and do the math. So we've had some people that are concerned about their mortgage and thinking about paying it off. To be honest, what we're telling people, we need to be in a situation of liquidity. If you do pay off that mortgage, that's great. We've saved that cash flow, but what we've locked up that equity. Just as we talked about earlier, if you want to have access to that equity, you're going to have to ask the bank for permission. And typically you only need that equity when you're in a financial bind, and banks are not going to loan you money when you are in a financial bind. And on that, so there's really three ways that you can get access to this. One is if you register, it's $300. It's a one-time fee, and you will get access to it you get lifetime access for it. If you're like, well, I'm not sure, and so that's for somebody who's like, I'm just enjoying Infinite Wealth content and I really don't want to work with them. Totally fine. Go ahead and have the content. Put that to work. No problem. But if you're like, I'd like to know a little bit more and I'd like to work with you guys, if you click this button here, we're going to ask you a few mild questions. We're set up a discovery call with Cameron and I, see if we're a good fit. If we're a good fit, then we're going to give you free access to it. If you are a client, email Cameron or I or Becky, and we will send you a link that will allow you to have free access. I also have open what the community that Cameron had talked about. They set up a separate page for our listeners. It's typically $400, but right now it is going to be free. So we're going to put this in the show notes. We're also going to email everybody an email with all of these links as well. And one other thing that Cameron and I have been working on, and we just put it into the top priority, is we will be releasing an updated ebook called Financial Planning Has Failed. which I think is just great timing for what is going on right here. This was written before this crisis here, but there's going to be some great information in the book. And there's also going to be some great videos as well that will be free. And hopefully we can launch that within a week. But once we do, we will be promoting that.
Great. And for everybody listening, while Anthony was talking and describing some of those opportunities, I was putting the links in the chat box. So make sure you guys check those out. And we did get one comment from Beck. It says, Patricia says she likes this picture of you. You look like a model.
She's talking about me?
I guess so. But my response to her was that I think Patricia needs glasses. So maybe
then she needs glasses. Then she is talking about me. Let's see. I have another question. Let's see. Chart. Okay, well, sorry, somebody was sending me a joke.
So Dan Barrett has said he's got a question. Do you think there will be inexpensive real estate investments in places like Italy to buy soon? How do you buy international real estate?
I love that question. I tell you, probably the biggest question that I've been getting has been, what opportunities is there going to be? When I tell you, when everybody asks that question, I love it. And that means that they're not focused on what's going on today or worrying about today. They want to be in a position for tomorrow. So we're encouraging people to take this time and start doing some research, take on some of this content. And I think right now it's too early to tell you like what the opportunities are going to be. But what we can do is tell you some things to look for, right? What are some of the things that got hit the hardest right now? Like that last question is Italy got hit really hard. So Italy is going to be a prime opportunity there. Actually, Italy was struggling financially beforehand. You could actually buy a house. I forget what, it might have been Sicily, but you could buy a house for $1 in Italy. They were looking for taxpayers, or they have a lot of some vacant homes. So Italy is going to be, there's going to be some opportunity there. Internationally, I mean, that is way outside of my area of expertise, right? But I love the way you're thinking. But start thinking, what are some other things that are being hit really hard right now? A couple that come to mind are the airlines. I mean, we actually work with a lot of pilots. Travel is almost coming to a halt. There's going to be opportunity in those airlines. Food and beverage is being hit. Like everything's being hit. Well, we need to figure out what were things that deserve to be hit and which ones are going to recover faster. A couple other things that I think are going to be some opportunities is during this crisis, people are going to be unable to pay their bills for a while. They're going to be late on their payments, late on their mortgage. Their credit is going to go through the floor. When this all settles, their financial issue was because of this crisis. It wasn't because of anything that they did. When they want to go out and buy a car or particularly a house, they either may not qualify or they're going to have a very high interest rate until their credit card spikes up or their credit report. You know, one thing we've talked about is one of our 5 pillars of wealth is lending. We don't talk about it that much, but lending, I think going forward is going to be a great opportunity. Because again, there's going to be people who have the cash flow to make their payments, but they're because of this issue, this crisis, their credit has been hindered. Now, So you could also go back. We'd interviewed a hard money lender, Steven Cinco. So I would go back in there and take a look at that at that podcast. There's also some talk about us getting hit with inflation, because the government is. We're already spending more money than we're taking in. We're on record to have $1 trillion deficit in just 1 year. That's before this talk about sending everybody a check and doing some of these other things. One thing the government could do is print more money. When they print more money, that is what's creating inflation. A lot of times people think, like, let's say Cameron's hair product, is $10, right? But then he comes back a month later and it's $20. That might not be inflation. It could just be because it's in a high demand, because people want to look like Cameron. But what inflation really is when we are printing money, where we're putting more money into the system. Then by doing that, each dollar has less value. That's what's creating inflation. And the government has been printing money since 2008. Well, you may have heard of the quantitative easing. They're pumping money into the economy. There's going to be a time where we're going to need to pay the piper. And one I think is going to happen is inflation has the potential to skyrocket. So then we want to look at what are some assets that maybe you would classify as a hedge against inflation. I will say one of them is cash value life insurance, but also I'd want to look at rental real estate. Particularly right now, there's going to be some good purchases on homes, and right now interest rates are super low, so you can get in a 30-year fixed mortgage and you rent it out. Remember, you're not paying that mortgage, your tenants are. You do need to have some money in reserves for vacancy, but if and when inflation happens, you have the ability to raise your rents. But your biggest payment is your mortgage, and that is going to be fixed. There's going to be some opportunities here for buying cash flow real estate.
Good point. Phil asked, and you kind of touched on it. It says, in regards to the Vegas residential real estate market, is there insight at this early point? And what I would recommend is we did have Zach Walker leave. We interviewed him about a month ago on our podcast, and he provided some tremendous insight on Las Vegas real estate market and kind of some of the factors that are pushing prices up and supply and demand. And so maybe take a look at that one. As far as right now is I'm not aware of any insight that has come out, but outside of kind of what Anthony just touched on is I think just overall this situation is probably going to get worse before it gets better. So when it does get worse, there'll be some opportunities there to maybe pick up some rental properties here and there. So Anthony, you got anything to add to that?
Yeah, no, that was a great answer. And thanks for asking, Phil. What I will say on there, just like what happened in the last recession, people got knocked down a notch. And people maybe had to get into a smaller home, or maybe they sold their home and had to rent. I think the rental market is going to be a good opportunity. Personally, what's been happening in the past, I thought the rental market in Vegas the numbers did not make sense. What we recommend is you're going to buy real estate, we want to do it for cash flow, not for appreciation. As long as that's cash flowing, as long as you have a tenant in there, you are going to have that cash flow. The appreciation, we do not have any control of. So there's going to be some opportunities, I believe, if you buy it at the right price. Also, just to reiterate what Cameron said, Vegas up until now is very difficult to find a good cash flowing property, which is why we'd work with some people outside of Nevada. In Memphis, which I was actually going to go out there in a couple weeks to personally meet the team at Mid-South HomeBuyers and look at some properties there. Obviously, that's been not canceled; it's been delayed. I will go out there, but remember, in Vegas, the average house is like 300,000. In Memphis, it's 100,000. So what that means is you can buy a property for about $22,000 in cash. I mean, in cash in regards to the down payment. You know, I do have, Cameron, I'm going to give this question to you because sorry, I've been talking a lot. Again, this is from JC. This one is not about your hair products, but what it says is, what are we doing to help people that are losing money inside their retirement plans, like a 401k? How do we help them?
Man, I would tell you, you and I have been on this mission for 10 plus years, right? And so we've been out there getting the message out that there is an alternative to kind of being subject to the volatility of the market. And so our clients are safe and secure when they do have their cash and their cash values inside the policies. And so right now, man, this is why we're coming to work, right? We're coming in here, we're doing this, right, to let people know that there is an alternative, and we're getting the message out. We're doing the best we can to kind of let people know that, you know what, the default of putting money into a market-based account is not necessary, and in fact is probably doing more damage than it is good. And so that's what we're doing, right? Is we're doing the podcast. We're getting out as much information as we can to let people know that there is an alternative here. And we just had a few other questions that came in, and this is from Dan.
Hey, Cameron, you mind if I?
No, jump in. On that? Yeah.
Talking about the 401k, you know, we have what we call our hierarchy of wealth. Meaning that at the beginning, just like Maslow's hierarchy of needs, that you need food and shelter, you know, before you look for safety, before you look for a mate. We have the same philosophy when it comes to your wealth. That first step should be having cash and cash value, and then we slowly go up the hierarchy. What's on top of that tier 4 is what we call speculative. These are assets that we have no collateral, no control, and no certainty. We don't recommend you go into that category until you've maxed out the ones before that. This is one of the biggest issue with typical financial planning. They want you to start with speculative, invest in the market, and then have a little bit in cash. We are the exact opposite. We're big on liquidity, having certainty and control. It's boring, but again, right now I'm saying boring is the new exciting. Now, a lot of people have money inside their 401k. That is not designed to be used in a time of need like this. There's limits on how much you can borrow. And also realize if you do borrow against your 401k and you get laid off, you need to pay that loan back, I believe, within 90 days, or it's going to be treated as a withdrawal, and you pay a penalty if you're under 59.5 and taxes. This is another example why you don't want to have you need to have money outside of the market. We're not saying never go in the market, but right now, if you need money because you need to pay your bills because you got laid off, you need it to be accessible. Everybody who has all that money in the stock market, they need that to pay their bills, but there's a couple of bad things about that. They're selling at the bottom of the market, or assuming we're at the bottom, but you're at least selling when it's low, then you're paying taxes and a penalty. On top of that, when things turn around, you can't just simply go ahead and put it back in. There's limits of how much you could put in your 401k. When we compare that to one of these IWC design policies, you can use that cash value now, pay your bills, and then when you get back on your feet, you pay that back, and your cash value continue to grow every year. If somebody is in the 401k right now, what we would encourage you to, if you're worried about that, let's set up a meeting and talk about those options.
Great. Thanks for adding that in there, Anthony. And then Dan also asked, what are the casinos doing? Will there be some sales on casinos? I'd love to buy Caesar's Palace. Great stuff on this call. Thanks, Anthony and Cameron.
That's you, Cameron.
So I'll tell you. So yesterday, Dan, I read an article of what's happening. And I don't know if you live here in town or not, Dan, but the casinos are closing. If they haven't closed already, there's report after report of some employees testing positive for the coronavirus. So essentially, I believe almost every casino is closed at this point. Mm-hmm. And what's funny, not funny, the article that I read yesterday is that the executives are still receiving paychecks, and some of the employees too, right? So we've got a bunch of clients that work in the casino industry, and they are laid off at this point. They have a 30-day window. They are receiving kind of their base pay. But the executives specifically, those guys are also receiving paychecks. And the article that I read highlighted 4 individuals that were doubling down and buying large amounts of the stock of casinos. And so, the stock, right, again, is we're not big stock market guys as far as, hey, don't be subject to the market. Don't always have your cash kind of subject to the whims of the market. But man, if you see stocks, or you see casino stocks in specifically as undervalued at this point, man, that is an opportunity for you to move into them and purchase them. And when they rebound and when they come back up, man, it's just like anything else, is take the money and run, right? Cash it out, put that money back into a policy, and look for the next opportunity. So if you're looking for opportunities to buy, I would say right now maybe a good opportunity to buy some casino stock. So that'd be my 2 cents on it. That's what the executives are doing. And I don't know if you got anything to add there, Anthony.
Well done. No, great job, Cameron. I'm going to add something to what I said, or expand on what I said earlier about opportunities. Dan actually reminded me, we're big on investing in yourself and your business. When this dust settles, there's going to be opportunities in your business, whether some of your competitors may be going out of business. Maybe you could hire some of that key staff. Maybe there's some equipment that you could use. Also, I'm imagining there's going to be some opportunities to either buy or lease commercial property. So this might be an opportunity to renegotiate your lease, or maybe expand into another office or a smaller one, or potentially even buy a commercial building.
I have got a couple of these messages so far in the question and answer box. Our chat box, for whatever reason, isn't working. I've been adding the links there. And so at the bottom of the screen, it's got a little sign here. It says Q&A. If you want to click on that, I've been interacting with everybody, and I've been sharing the links with individuals that had asked for them there. So Sam, I got yours, and there's several more that have just asked for them. So I'll be sharing those with you guys individually. And if for whatever reason you guys didn't get them during this call, shoot us a text. We'll make sure we get these resources out to you guys today.
Cameron, I do have a question from Jim. He listened to our podcast, I think the last podcast we had, and that was when we had interviewed Todd Langford. He's one of the creators of one of the calculators, or the main calculator that we use. And I would say he's an expert in investments and whole life and how the numbers work. And one thing we had talked about there is that life insurance is not an investment. It is a savings. It's savings. And when I talked to Jim about that the other day, and he goes, well, he was arguing with me on that. He goes, look, I'm earning between 3 and 5% in my policy. Right now, that's much more than what I'm earning in the market. And also, remember that 3 to 5%, that is net, right? That's after paying fees to Wall Street and your financial advisor. So typically, even if in your low interest fund, the true fees are really going to be about 1.5 to 2. So if we just say you're earning 4, that means you need to earn 6%, pay Wall Street to equal what your policy is doing. In addition, your policy is tax free. So you may need to earn 8 or 9%, pay the IRS, pay Wall Street to be left with what you have inside your policy. And I think he reminded me is that we do need to tell people that, right? And I know in part the one reason why we don't, because we don't want to get into interest rates, right? It's really, and you know, if you can get a better rate of return than 4%, then we want you to. This is when this is an asset. Take your cash value and take advantage of that opportunity. Then when you sell it, you need a place to store it. Put it back in your policy, ready for the next investment. Now, we're going to do a podcast on the difference between savings and investing. And what our view on savings is, this is money that you want secure, that you know is going to be there. And that's exactly what cash value life insurance does. And investment, we are expecting a higher return, and we're also accepting some risk. In whole life insurance, you're not taking on that risk. Your money is just steady Eddie, right? Very boring. It's like talking to a CPA, right? Amazing, brilliant, and smart, good looking, but just boring. Just goes.
I don't know any of those.
A little bit. Now, Karen, why don't you take this one? Because I'd mentioned cash value life insurance, but that also entails VULs and IULs. So how are those guys doing right now?
Those guys are going to. I was actually just responding to the question in the box here. Is that so IULs and VULs? Those are I don't want to say market-based accounts because they're not actually invested in the market, but they mirror the market. And so those are going to be performing very similar to how the market is performing. And again, we've got that volatility. And so again, we've touched on this before, is that, you know, in times right now, when the market, the stock market drops, if you're in it, you're subject to that. If you're not in it, you can simply view it as an opportunity, right? And you can move in and you can make some money and get back out. And so everybody that has an IUL, everybody that has a VUL, they can't touch that money, right? Is because we've talked about this before, is the worst thing that you can do on those types of investment accounts is pull money out in a down market. Where we got money in a life insurance policy in a down market, it just simply becomes another opportunity for us to move in. And so that's how those things are going to be performing. That's why we're not big fans of them, is because of the volatility that you find in those. And then also because those are built upon really that term policy. So, you know, that's right now is one of the reasons that we want to stay away from them. And so I hope that helps.
Yeah.
JC,
So
go ahead.
One thing we want to hit home is IUL's Index Universal Life. Those are sold where there's no downside, right? So what's going to happen this year, in essence, the way those work is you're credited when the market goes down, you are credited zero interest. So your cash value, because of that, doesn't go down. However, there's still cost of insurance and fees. Those still need to be paid. So even though you're credited zero, your cash value is going to be less than what it was last year. And with the VUL, I really hope nobody's in a VUL anymore. I was, until I actually read the policy and saw what could happen, there is no floor on the VUL. So those right now are tanking. And some people are, well, I already lost money, so I don't want to pull it out because that's what my financial planner is telling me. Who knows what's going to happen? I don't think that we've seen the bottom. And as we said earlier, we were due for a recession anyways. This is just going to make it worse. I don't see the market rebounding anytime soon, but that's where we want to empower you to learn more about the products that you have and determine what product is going to be best for you. Now, Cameron, I just got a text question. They had asked, well, I'm 61 years old. Am I too old for whole life insurance? What would you say?
I'd say absolutely not, right? 61 years old is, people have this, this kind of arbitrary number of 65 that they have in their head that they plan for. And in reality, Anthony and I have had this conversation many, many times, is I think that some of our clients have kind of this, are kind of short-sighted, to be honest with you, is, man, we're not planning for age 65, right? We're planning for age 85. We're planning for age 90 and 95, as people are living longer, right? Just with medical advances and just quality of life. And so, man, if you're 60, you're in the prime spot to be doing some of this planning. And if you think about the traditional advice that is given is, at 60, if you're in an investment account, most of that's going to be made up of bonds anyways, right? And so what we talk to clients about at that age is, hey, all we're doing is replacing kind of your bond portfolio with cash value life insurance. And now you've got a death benefit, and you've got the stability that comes along with it, and you've got access to the money. And so those are kind of the examples that we'll go through with somebody that's 60 plus. And man, I think the oldest I've had anybody ever underwritten is probably mid 70s, 72, 73. And the sentiment there was, man, I wish I would have got started sooner. And so it's never too late to kind of get planning. And man, we've got to have kind of a longer view on what our plan is actually going to be. So I hope that helps.
Yeah. What I would add, there's a lot of misconceptions about life insurance. People automatically are focused on the death benefit, but we design this actually to minimize the death benefit and maximize the cash value. One thing I tell people when they say this, let's say the 61-year-old, if we put a policy, the same premium on her, let's say on their 40-year-old son and their 20-year-old grandson, okay, and let's say there's a newborn, all right, he's 20, so he's starting early, right? If we were to put the same premiums on each member of the family, who would have the most death benefit? And really, the younger one is going to have the most, and the older one is going to have the least. But really, we're not doing this for death benefit. We're doing this for cash value. Who's going to have more cash value in day one? We have a 60, a 40, a 20-year-old, and a 1-year-old. The way we design this, they're all going to have about the same amount of cash value in day one. As we go out further, the younger one's going to have more cash value, but at the beginning, we are starting really at the same place. We're just putting a policy in place with a family, and she's 60 years old, and they're sitting on some cash and are worried about the banking system. We went ahead and put it into a special type of policy where she has the liquidity she has. It's almost the same to what she started with, but now the money is safe, it's liquid, it's asset protected, and it's out of the banking system. So what we encourage you to do is, if you have any questions about this, let's try to put some of the preconceptions you have about life insurance. Just realize that we design things very different, and we can get on a call and explain some of these options. and how this works. That's all the questions I got, Cam.
Me too. I was just kind of going through and looking over our notes and just kind of wrapping up here. Number one is, man, it is what I hope in clients take away from this is just a friendly reminder that, listen, your cash values are not tied to the stock market, right? And so no need to panic, right? Remain calm. This is why we use the products that we use. And number two is, hey, if you need to adjust your premiums, call us. We're happy to go through that exercise with you and go through the options that are available to you. We addressed a couple of them earlier here. And then number three is, man, is be ready, right? The reason that we use these accounts is because they're not market correlated. And there's going to be some opportunities that present themselves here in the next couple of months. And whether that's investing or whether you just access some of the cash values just to kind of get yourself through for the next couple months, there's available to you as well. Call us. We'll help you through that through those options as well. And then, man, that's really it. We've got some of the opportunities that we talked about, some of the things that we could do here moving forward over the next 30 days is revisit the podcast. We talked about Liz Nowling, Mark Podolsky, Alexander Felice. Reach out to us. We'll give you access to the Infinite Wealth course. There's a ton of information that's in there. A great time to kind of revisit this idea and these strategies and refamiliarize yourself with those. And then bigger pockets, right? A lot of these Q&A, these answers, questions that came up in the Q&A box really revolved around really revolved around real estate. So bigger pockets is a great resource for that. So we got one more comment. A couple of them. It says, thanks. Great stuff, guys. I appreciate this so much. So glad I got my 401k out into an IBC plan. Thanks a ton. Thanks, Anthony, Cameron, and Becky, for all you do to help us learn and implement. So we're happy to be here for you guys. We're available, open office hours. We'll be wrapping up here shortly, but if you guys need us, call us. We're always available for you.
You know, let me share a text that I just got from one of our clients. He's a physician. He says, great advice and summary. It's like turning my patients or telling my patients to wash their hands. All of a sudden they listen. That's just sort of what you guys have been telling us for the last 7 to 8 years. But
so true.
Maintain positive. I would limit how much you are reading and watching the news. Focus on what you can control, and let's take advantage of this time. And there's going to be opportunities. We are going to get through this. And any questions or concerns, Cameron and I and Becky are here to help. Go make it an awesome day.
Thanks for listening.
Take care,
be
guys.
sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.